Class number 6, Assets 201. Once you get past the basics and start to dig into ALM, you need to look at your assets a little more closely. This class will get you started.
A major responsibility of the board and management of a credit union is to control and mitigate the risks in the financial statement. One very important risk is credit risk and can generally be found in the loans and investments on the credit union's balance sheet. The allowance for loan loss account is considered a contra-asset and is found directly under the loans and lease general ledger items on the credit union's balance sheet. It's used to devalue those assets, and it's funded through the provision for loan loss account. When reviewing the assets of a credit union, a board member should pay particular attention to increases in the allowance account, the other real estate owned, and collateral in process of liquidation, as this may describe to the board an increase in default by members. A responsibility of credit union board members and management teams are to evaluate the collectibility of member loans and leases. At the point in time that they determine that they are uncollectible, they classify them. A common term used when evaluating a financial statement is loaned out. When the credit union is loaned out, what that generally means is that all the savings and equity of the credit union has been lent to members. At that point in time, the board should be considering another risk, that being liquidity. There are two types of assets in a credit union's balance sheet: those that earn money and those that do not. Typically, non-earning assets would consist of cash, building, and other assets that do not have an interest rate associated with them. Non-earning assets do have a drag on the credit union's earnings capability.
A non-earning asset is an asset on the books that does not produce revenue. For example, cash.
There are credit balances or negative appearing numbers on the balance sheet of a credit union. These are called contra-asset accounts and are used to either devalue a loan portfolio or display to the board member those loans which have been sold to other financial institutions. On a monthly basis, management must evaluate the quality of the investment portfolio. In some cases, many of the securities must be repriced in accordance with market conditions. However, all securities, such as CDs held at other financial institutions, do not need to be repriced. During this month's review of the credit union's balance sheet, you as a board member have discovered that the credit union's assets are increasing dramatically fast. Should you be concerned? Yes. Number one, are the credit union's rates higher than market? Number two, are you lending the money out? Number three, are you actually diluting the quality of the capital of the credit union quickly?
Of all assets owned by the credit union, loans and investments contain credit risk. The allowance for loan loss is based on an estimate of the potential losses in the loan portfolio. It is a contra-asset account and reduces the value of the loan portfolio. It is also funded through the provision expense account. An increase in the following asset line items should be considered a negative trend and closely monitored: allowance for loan and lease losses, other real estate owned, and collateral in the process of liquidation. Classified assets or impaired assets are considered as loans and other receivables due from members whose collectibility is in doubt. A credit union that has loaned out all member savings and capital and must borrow from its correspondent must actively manage liquidity risk. Non-earning assets generally have a drag on earnings as they have no income associated with holding them. They consist of cash, buildings, and accruals. In general terms, a contra-asset account is a credit balance line item on the asset side of the balance sheet that is used to reduce the value of a line item. It also displays loan participations sold. Except for certificates of deposits held at other financial institutions, credit union investments should be repriced every month to show their value relative to the going price of like investments. A board member should be concerned over a dramatic growth in assets over a short period of time. because without corresponding strong earnings, they could dilute the net worth ratio of the credit union. This may bring in too much cash that cannot be easily lent out. It may also be a sign that the credit union savings rates are too high. Time to take the test. Good luck.